Hello friends, welcome back to Striving Aspirants. Today I came with another important topic in accounting, that is accounting ratios. In this video presentation we will be looking into the meaning, objectives, advantages and types of ratios. Here we are talking about ratio analysis. As the name indicates, there is ratio and there is analysis. So on what platform we have to do this ratio analysis? It is right that we require one platform to do this analysis, right? And the answer is financial statements. We have to do analysis on the financial statements amounts or figures. As we know, financial statements, it provides financial information to the users of the organization or the decision makers in the management desk. In other words, these financial data that is taken from financial statements is required for the analysis, comparison and interpretation for taking decisions in the organization. These decisions are important for the internal users, that is the management guys, and the external users. So this term is called as financial statement analysis. When we take ratio and when we calculate the financial statement analysis, we will get necessary information for the decision makers to make changes, necessary changes in the organization structure and the ongoing activities in the organization. Apart from the accounting ratios, we use techniques like comparative statements, common size statements, trend analysis, cash flow analysis for the financial statement analysis procedures. The techniques of accounting ratios are used for analyzing the information contained in the financial statements for assessing the solvency, efficiency and profitability of the firms. Let's check what is the meaning of accounting ratios. As we said before, accounting ratio is an important tool of financial statement analysis. Now regarding ratio, it is a mathematical number calculated as a reference to relationship of two or more numbers and can be expressed as a fraction, proportion, percentage and a number of times. As we can see, the ratio, it is the relationship of two or more numbers, where we take certain amounts and then we will calculate the proportion or the percentage or the fraction, and we will compare each other to get a particular amount. Here we can see one example. If the gross profit of business is rupees 10,000 and the sales are rupees 1 lakh, here we can calculate the gross profit ratio is 10%. That is 10,000 divided by 1 lakh of the sales. It is important that there should be some sort of relationship between the numbers we are taking from financial statements. In other words, a ratio must be calculated using numbers which are meaningfully correlated. If they are unrelated numbers, then there is no purpose of calculating these ratios. Let's see one example here. Furniture is given 2 lakh and purchase 4 lakh. The ratio of purchase to furniture is 2. that is 4 lakh divided by 2 lakh. Calculation of this one is not having any relevance here. The reason is that there is no relationship between these two aspects. Now let's look into some objectives of ratio analysis. First one is to know the areas of business which need more attention and care. Second point, to know about the potential areas which can be improved with the effort in the desired direction and planning. Third point, to provide a clear-cut analysis of the profitability, liquidity, solvency and efficiency levels in the business. Fourth point, to provide information for making cross-section analysis by comparing the performance with the best industry standards. Fifth point, to provide information derived from financial statements useful for making projections and estimates for the future. From all these points we can say the ratio analysis is all about analyzing figures in order to know the problem areas in the organization so that proper attention and care can be taken. Proper planning can be taken in order to improve the problem areas, and we can make the future of the organization better. Here are some advantages of ratio analysis. It helps to understand the efficacy of decision. Ratio analysis helps you to understand whether the business firm has taken the right kind of operating, investing and financial decisions. Second point, simplify complex figures and establish relationships. It means the ratio analysis will help to summarize the financial information effectively and assess the managerial efficiency, firm's creditworthiness, earning capacity, etc. Another point, it is helpful in comparative analysis. As we know, ratios are not calculated for 1 year. We will be taking many year figures to compare. Means previous year's figures we will take to compare with current year figures in order to know what is the correct trend going on in the business. Another point, identification of problem areas. It is one of the important points to identify which area is having problem and to take care of that area in order to improve in the future. Another point, it enables the business for the SWOT analysis. SWOT means strength, weakness, opportunity and threat. So ratio analysis will helps to find out the weakness and the threat in the organization, and that will help to strengthen the business and the opportunities we can find out from the analysis we have done. Another important point is various comparison. Comparison is taking on the basis of profitability, liquidity, solvency, etc. of a business. This type of comparison may include intra-firm comparison, inter-firm comparison, and with the standard set for that firm or industry, that is comparison with standard or industry expectations. Now we will look into the types of ratios. This is the broad classification. One is traditional and second one is functional classification. Let's look into the ratios coming under traditional classification. First one is income statement ratios. A ratio of two variables from income statement. Means the figures will be taken from income statement. Example, ratio of gross profit to sales, known as gross profit ratio, is calculated using both figures from income statement. Second one is balance sheet ratios. Here the figures will be taken from balance sheet, so it is called as balance sheet ratios. Example, ratio of current asset to current liability is known as current ratio. So as we said, the figures will be taken from balance sheet. Third one is composite ratio. Here the figures will be taken from both income statement and balance sheet. Example, ratio of credit sales to debtors and bills receivable known as debtor turnover ratio. So it is calculated using one figure from income statement, that is credit sales, and the another figure from balance sheet, that is debtors and bills receivable. Now let us look into the functional classification. First one is liquidity ratio. Liquidity, we can say like it is the ability of the business to pay the amount due to stakeholders as and when it is due is known as liquidity. So this will be short term in nature. Here we check the business is having the capacity to pay the cash amounts as and when it is required to the outside parties. Second one is solvency ratios. In the case of solvency ratios, solvency of business is determined by its ability to meet its contractual obligation towards stakeholders, particularly towards external stakeholders. These solvency ratios will be long-term in nature. Now third one is activity or turnover ratio. This refers to the ratios that are calculated for measuring the efficiency of operation of business based on effective utilization of resource. And the fourth one is profitability ratios. It refers to the analysis of profits in relation to sales or fund or assets employed in the business, and the ratios calculated to meet this objective is known as profitability ratios. This is all about the first part of accounting ratios. In this video presentation, we have seen the meaning of ratios, the objectives, advantages, and the types of ratios we have seen. In the next video presentation, we will be checking the important classification, that is functional classifications, liquidity, solvency, activity, profitability. These all need to be checked with sufficient examples. So in the upcoming video, we will be looking into the liquidity ratios with examples. So until then, it is bye from striving aspirants. You will see in the next video. Subscribe and support us. Signing out, striving aspirants.